Welcome to Markets Now. I'm Michelle Rook along with Rich Nelson with Allendale, and we have some mixed trade in both grain and livestock futures as we move through the mid-session. And we had some pressure early in the grains this morning on the row crop side. Rich, it looked like from a change in the weather, we're coming off of our lows, though. Is that being, offset a little bit by some of the export news that we had this morning, or did we just find some support?
I think that's certainly the case. We do agree that this weather issue has cleared up a little bit of the concern here, especially with North Dakota going to see regular 40 to 49-degree highs here next week. We have removed the South Dakota risk, especially as they'll see 80 degrees next week. But certainly from the trade's perspective, with a lot of planning still in front of us, we still need to have some type of mild premium, if nothing else, as we go through this next few weeks here.
Yeah, though we don't have much weather premium in December corn right now, do you think?
And that's a big question, especially as we're still struggling to make this new crop balance sheet look as bullish as what we want to see here. Even if you take off 2 million acres for plantings, assuming North Dakota problems, even if you take off a little bit of weather premium, maybe 2% off trend yields, we're still struggling to make a balance sheet, which suggests we need to have a strong rally. So at this point, we're kind of stuck in neutral waiting on this risk issue.
Okay, so if you do the math on that, where does that put us for ending stocks? We're above 1.5, I would think. Are we, in between there and 2 billion bushels, or where are we at?
If you do take off this 2 million acre discussion, also you take about a 2% premium off of yields, just because a lot of people don't feel trend yields are realistic this year. You're still looking at about 1.5, 1.6 for ending stocks, and that's going to get this December corn discussion right around that 560 to 540 range. So even respecting some issues, the new crop balance sheet's still a little trouble right now.
You bet. What about the soybean balance sheet? What do you see there? Because with what we work in from the quarterly stocks, obviously old crop has got to be below 200 million bushels, but we also look pretty tight as we come into this next season, don't we?
That sure is right. So Friday's report for both corn and beans suggests we do need to raise domestic usage in that feed residual category. Big question, especially as we head into Tuesday's report, will be what USDA does with export sales. At this point in time, even with China buys on corn and even with hopes for China buys on soybeans, we do have one export sales here this morning on the soybean side. We're still a little behind where we should be. So a lot of the trade expects maybe some lower stock numbers for Tuesday. Question still is with the export discussion.
Right, because that's what we usually look at in the April WASDE is the change in the balance sheet comes on the demand side, not on supply side. So what are you seeing on, corn export changes with this China business that we've had recently? Will USDA make any revisions?
And that's a big question. Now, keep in mind, before China started buying, we were in the hole. We had a deficit for needed corn export sales. We've probably solved about 3/4 of that hole, so to speak. So USDA could lower, believe it or not, corn export sales next Tuesday. We don't think that they will, but they certainly could. Soybean side of things, same type of story. We're currently operating about a 20 to 60 million bushel deficit in needed export sales. With these hopes for China buying, USDA could stand pat in these numbers. So we could see lower corn and lower soybean stock numbers, at least for the April report next Tuesday, then maybe revisions after that.
All right, you just put out your trade guesses for the WASDE, and so where did those come in at?
So we probably will be the oddball as far as most other analysts. We're expecting corn export sales unchanged, or corn ending stocks unchanged, 1.342 billion. So we have plus 50 for feed residual, but we still have taken off 50 for export sales. Soybean side of things, we actually do suggest an increase for the small feed residual category, plus 25 million bushels. The question we have is about this export sales deficit. So will be unusual. We actually do have a higher ending stock for soybeans plugged in. Most others will suggest lower stocks.
Gotcha. So while corn and soybeans have been able to come off their lows this morning, the wheat market is still trading lower in all three exchanges, despite the fact that HRW wheat had a 28% good to excellent crop rating is all in the weekly report. Are we trading now, looking at the forecast ahead, thinking that those numbers could improve, or what are we trading, Rich?
I think right now we're trading non-U.S. factors. So it certainly is just
Okay.
the world balance sheet, and the trades mindset is what's determining even our own wheat prices. So I certainly respect the fact that these hard red numbers, whether it's a yield impact or abandoned acres, we all agree that this condition issue is not going to improve, especially given this forecast next 2 weeks in the plains. So This is a key issue for us determining yields. Spring rains are about 65% of yield determination. So our key issue right now is we're not getting the help just yet, but this wheat balance sheet is not in the trade's mind a factor for determining prices.
All right. When you say it's outside of US factors, then is it because we're not competitive on the export front? Is that what you're alluding to?
And that sure is right here. And keep in mind here for wheat exports, they're roughly about half of our whole domestic balance sheet here. We do have, of course, feed use, which is a stable category. And then we have a small feed residual discussion. So our wheat balance sheet is very heavily weighted for this export discussion. And so far, we're still a bit behind on those type of sales here.
Okay. Yesterday, we arguably had a little bit of risk off that hit the grains as well. What do you see right now in terms of the macroeconomic climate? There's a lot of talk about crude oil now with OPEC's cuts, maybe going back up closer to the $100 mark, and that may trigger the Fed to have to increase rates again. How does that all play out?
It's a very good point here. So we still have this question about what type of recession risk or what type of interest rate changes we'll be seeing these next few weeks. At this point in time, I'm still taking kind of a mixed viewpoint on the whole issue. For Friday's employment report, we'll see numbers having a decline versus February. So February was 311,000 jobs added to non-farm payrolls. Trade discussion is 204 for Friday morning's report. So I don't think we're going to get a firm answer just yet from this outside discussion.
So, do you think it's too early right now for producers to be locking in some of their fuel or diesel needs here for spring planting or not?
Actually, I think this is just fine. You know what, like you just mentioned, we are off the lows a bit here, but a lot of the trade still expects further higher price action. Keep in mind for crude, the general story has been one of disappointment for several weeks and several months. So I think it's great to just higher prices, and I would get spring and early summer needs taken care of. But at this point in time, I'm not quite sure if we need to panic just yet and go whole hog on and getting whole year needs.
Right. And hopefully we won't hit those record prices that we saw last year because I think we do have refining capacity is better, isn't it?
And that sure is right here. So our main question is really about this demand structure. On the positive side, as far as this weekly EIA report we got in this morning, it did show good general gasoline demand, which is quite positive. And now we have 2 weeks in a row of good numbers after what's been a terrible several week and several month period. So on the positive side, the question is about demand, not really about the plants right
Okay, so hopefully that will help the ethanol margins as well. So let's talk a little bit about cattle. We're back up here today. It looked like we maybe put in a key reversal here earlier this week, but do you think we're trying to price back in some better cash trade ideas here today, or is it because we've had such a big move here in wholesale box beef values?
I think we have taken with yesterday's move, we did take a little premium added that was put in last week due to the storm issue being perhaps not as aggressive as a trade one to see, especially as it's not going to be a Nebraska processing plant issue. So on the cattle side, I still think we're questioning about this near-term supply. Seasonally, we do pick up in these next few weeks in offered cattle numbers. However, we do expect numbers to fall short of the normal seasonal increase, probably around July. So in the near term, we would suggest for this week, stable cash cattle pricing, maybe even a dollar higher, but there is still a little pressure probably lined up these next 4 to 6 weeks where the good news starts later on the summer.
Gotcha. Is there any light at the end of the tunnel for the hog market here, Rich? I mean, we fundamentally cash trade is down, cutouts are down to levels we haven't seen since the end of 2020, and the funds are still record short. So, like I said, is there any light at the end of the tunnel?
It should happen. It should happen probably mid-month. That's when the this next phase of declines for U.S. offered hog numbers shows up on a seasonal basis. Also, that's when we'll have a more valid discussion about some spring or early summer outdoor grilling demand, so to speak. But in the short term, for the next week ahead, I can't say we've got things solved here just yet. Past 13 days, we've seen straight declines for cash hog prices. Wholesale pork is now 26% below last year. So it's a great story, perhaps in 2 weeks, 3 weeks from now. In the short term, no, I can't suggest we resolve this issue.
Are those fundamental fundamentals just a result of slower demand, or is it because we have more hogs?
On the hog side, we're running about maybe 1.5% more hogs than last year. So it is slightly higher than what the trade wanted to see, but in terms of the actual numbers and the impact, this is not really the main driver of our problems with hog prices. So we do have a little pushback on the consumer side. We'll see how long this lasts, though, especially given our questions about summer demand ahead.
All right. Good discussion as always. Thanks so much for joining us, Rich Nelson with Allendale, and that's Markets Now.